Hello and welcome to Your Money, Your Call. I'm Kim Slater. If you have a question about shares, our phone lines are open on 1300 30 34 35, or if you prefer, you can email us at yourmoney@skynews.com.au. Joining me tonight on our esteemed panel is Michael the Heffernan from Lonsec. That seems to have stuck, that moniker.
Thank you very much.
And Ben Clark from TMS Capital. Welcome to the program, gentlemen. First of all, it was a day of data for the market. We had the GDP figure, where to interest rates, we had the Chinese PMI, we had equity capital raising, and we had the underpants rally in the US. But first of all, let's deal with the serious stuff. The GDP figures out today. There's a lot of criticism about the Reserve Bank. The equity market's always trying to anticipate where the economy's going. It looks like growth is going to be lower for the next 12 months, and we have this sort of dichotomy happening at the moment in the market. Well, is it going higher, is it going lower? It looks like it wants to go higher, but the fundamentals for the economy, at least the Australian economy, are looking somewhat less than robust. So, first of all, Ben, what's your view on the call for the market at the moment?
Well, I think the biggest announcement for me, was the rate cut, rate cuts have a huge impact on equity markets. It means that companies' debt becomes cheaper to finance. It means that at some stage we're going to start to see a pickup in the general economy. People will start spending again, and also, of course, it makes the high yields on offer in our share market much more attractive. I think sort of looking forward, Kim, I think that there's a lot of reason to be confident. I take your point. I mean, we've just been through AGM season, and I went to a fair few, and across the board, CEOs are still very cautious and I would say pessimistic. There's very few that are willing to stick their neck out and say this year's going to be a good year for us. But I think that 12-13 is going to be the sort of the bottom of the earnings cycle, I'm hoping. And I think what's happening at the moment is the equity market starting to price in a recovery in earnings in 2013-14. The market will price that in ahead of time because I think rates will have to start to pick up activity in the general economy, and also CEOs have cut costs markedly in the last year. I mean, Macquarie's let go 1,900 people in Sydney in the last year. So they're all operating off really low cost bases now, and when you start to see revenues pick up, their profits are going to run quite hard. So I think we're seeing the PE expansion into probably 6 to 12 months ahead when earnings will start picking up, but it's not immediately obvious that that's happening.
We'll have to talk a bit later in the program about the stocks that are going to be the beneficiaries of that.